Hey everyone, Asher here, and wow, this week has been packed with movement across the board. Stocks, bonds, and housing all shifting at once. Let's dive into the key headlines and what they mean for you and your clients. Let's start with the markets. We've seen a big rally in the stock market, and interestingly, bonds are also up, meaning yields are moving lower. This isn't typical. Usually money flows between stocks and bonds, but right now it seems that both are benefiting. Why? It all starts with conciliatory comments around the US-China trade tensions and even some softer tones from President Trump about Fed Chair Jerome Powell. These reassurances have helped ease market fears. Treasury Secretary Scott Bessman also made headlines hinting at deregulation efforts that could lower mortgage spreads, which would help reduce rates for borrowers. That's good news for all of us in real estate, but it's not all momentum. We still need to be cautious. Mortgage bonds had a strong morning, but there's some tough resistance at the 250 and 25-day moving averages, which are all stacked together. That's a heavy ceiling, and it pushed prices back down below the 100-day moving average. The 10-year Treasury yield is sitting at about 4.33%, which is a key Fibonacci level, and it's finding support for now. If we close below it, we could see additional improvement towards 4.27 or even 4.23%. That could mean better mortgage rates ahead, but we'll need some confirmation. Now, let's talk about housing data. We had a strong new home sales report for March. Signed contracts were up 7.4% month over month, which shows that buyer interest is there, especially with rates in the 6.625 to 6.75% range last month. Some analysts are downplaying it, but even previous month's numbers were revised higher, not lower. This looks like it's a genuine buyer strength. It's not just a fluke. However, we also saw a jump in price cuts. According to Realtor, 33.9% of all active listings in March had a price reduction. That's the highest share in years and continues an upward trend we've seen since 2022. It's a clear sign that sellers are adjusting to more realistic buyer demands and affordability. Meanwhile, mortgage applications were down slightly last week, both purchases and refinances. It's expected with rates ticking back up a little bit and having some uncertainty in the headlines. But year over year, applications are still up, which tells us that as soon as rates dip, activity is ready to pop. Here's a big one you may have missed. The FHFA is now evaluating how to recall previously closed loans that were obtained fraudulently, even those that were done 3, 4, 5 years ago. This is a serious issue that could affect past files, so it's something that we all want to watch closely. Another major legal headline, a federal judge halted the CFPB's plan to lay off 1,500 employees, expressing deep concern about the administration's approach. That keeps the Bureau in limbo, but this move has a major implication for future regulation and consumer protections. So, what should you be thinking about right now? Stay nimble. These rate swings are tied to headlines and markets are moving fast. Talk to your buyers, right? I have tools available that can help us prepare so when those short windows do come up, we can strike at the best opportunity. And also educate your buyers. There's a lot of noise out there in the media, especially around price cuts or predictions of housing bubbles. Make sure they're hearing the facts from you, not those people. And that's it for this week's update. If you need any help strategizing around rates, buyer positioning, or dealing with hesitant sellers or buyers, I'm here to help. Thanks for watching, and I'll see you next Wednesday.